A complex system failure in the financial markets often begins as a sudden structural fracture under invisible pressure. During the week leading into August 26th, that pressure became visible. Market sentiment shifted toward institutional abandonment, leaving the tape vulnerable. By the end of the week, the three major U.S. indices were moving in a synchronized freefall. This creates a critical distinction for any trader. Is this a routine market pullback? Or are we witnessing a dangerous shift in the market's underlying structure? Navigating this volatility requires ignoring the emotional noise and adopting a professional pre-market routine based strictly on hard evidence. To find the answer, we are going to build an objective, tactical trading plan from the ground up, starting with first principles. This analysis is a personal view of market structure and does not constitute financial advice. All trading involves risk. Our working thesis for this session is that the market is entering a correlated short-term distribution phase. We need to look at the data to see if buyers have truly stepped aside. Attempting to guess the bottom is a common retail trap. A professional waits for structural evidence to dictate their bias. We'll start with the S&P 500 one-hour chart as our primary baseline gauge for overall market health. This chart shows a clear sequence of lower highs and lower lows. This pattern objectively confirms the current downtrend. The volume histogram confirms this isn't accidental. Large spikes during sell-offs indicate active institutional participation. Now, look at the final closing candle of the session. A close on the lows suggests a total lack of confidence in holding positions overnight. It shows that even at the end of the day, there was no significant short covering or dip buying. Because the institutional money didn't step in at the close, the structural path of least resistance remains down. We have to ask if this weakness is isolated to the S&P 500 or if it represents a systemic issue across all sectors. This is the Nasdaq 100. If tech were acting as a safe haven, we would see stabilization here. Instead, the Nasdaq shows an identical lower-low structure. Technology is facing the same institutional selling pressure we saw in the broad market. We see a similar pattern in the Dow Jones Industrial Average. This bearish market structure in the Dow confirms that capital is not rotating into defensive legacy names. This is a clear example of correlated selling across all three major indices. When the broad market, the tech sector, and the industrial sector move downward in lockstep, it signals a macroeconomic liquidation rather than a simple sector rotation. To see what's driving this drop from the inside, we need to analyze the market breadth. This sector heat map visualizes where capital is flowing out. The sea of red indicates that selling is widespread. In the mega-cap tech quadrant, traditional leaders like Apple, Amazon, Google, and Microsoft are all seeing heavy selling. These stocks carry significant mathematical weight in the indices. A rally is highly unlikely when the market's largest components are all trading in the red. The financial sector is also showing signs of cyclical weakness. Stocks like JP Morgan and Bank of America are compounding the pressure created by the tech sell-off. With growth and cyclical sectors declining simultaneously, the indices lack the internal participation required for a sustained, broad-based rally. The technicals are clear, but we need to identify the external force compelling institutions to liquidate their positions so aggressively. The source of the market's anxiety can be found on the upcoming economic calendar. On Wednesday, August 26, the market faces two high-impact risk events: the preliminary GDP and the Core PCE price index. Core PCE is the Federal Reserve's preferred inflation metric. The result of this report directly informs their future interest rate decisions. Many institutions are moving to cash to avoid the risk of a surprisingly high inflation print. This process of de-risking explains the aggressive liquidation we've seen on the charts. The current technical weakness is tied to macro uncertainty, suggesting that significant buying pressure is unlikely to return until the market has digested the upcoming inflation data. Analysis must lead to action. Based on this bearish structure, how do we trade the upcoming sessions? In a distribution phase, the absolute primary rule for any trader is to avoid buying blindly into a downtrend. Our tactical approach in this environment is to maintain a short bias, looking for opportunities to sell the rip. This means identifying previous areas of resistance. We look for the price to bounce into these supply zones before it encounters a rejection. During a distribution phase, low-volume bounces typically function as traps, providing professionals with the liquidity needed to enter short positions. We also have to consider the alternative. What if the market doesn't bounce and instead enters a period of high volatility sideways chop? In those conditions, it is important to remember that cash is a position. Preserving capital ahead of a major macro event, like the August 26 PCE data, is often more productive than forcing a trade in poor conditions. Our pre-market routine is now complete. We have defined the trend, validated it with breadth, and identified the macro catalyst. The objective trader doesn't try to predict the August 26 data. They position themselves to react safely by respecting the established market structure.